Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Joining us now from Wolfe Research, really one of the most interesting economists out there, Stephanie Roth, and she brings truly prodigious mathematical abilities. You remind me of Loretta Mester retiring at the Cleveland Fed. What does your mathiness do when you commit economics? What makes your economics study different because of your, Buckdell and Columbia world-class mathematics?
I mean, these days it's because there's so much seasonality problems in the data. That's been one of the most important things.
So you agree with Anna Wong at Bloomberg that there are data problems?
Oh, there are data problems in a big way. I mean, look at core PCE. In Q4, it averaged 1.5%, and in Q1, it averaged 4.2%. Inflation was neither. We're running somewhere around 2.5% to 3%. So there's just truly seasonality problems that are working their way through, and I think we learned that last week. And that's what markets
is the seasonality problems, and when you synthesize the math and the revisions, lead you to a greater disinflation.
Yes, and it leads me to believe that the Fed can cut in September.
See how she does that?
Yep.
When you're a math major, you do that. You don't say, yes, Tom. You say, yes, you stupid.
So what is
Save me, Paul.
So Stephanie, is the Fed behind the curve? Do you think should they have been cutting already, given some of the real-time data we see?
I mean, I think could they have cut in July? Maybe, but the inflation data were bad in Q1, and understandably they want to be convinced. So September, I don't think they're in a rush. September is perfectly fine. I think they probably need to be cutting this year, otherwise we might run into some problems similar to what we saw, a couple years ago with some of the regional banks.
So I mean, if I look at the interesting thing here for a lot of investors is it feels like that data we got in the first quarter about inflation, that suggests that inflation was still around. Yeah, we've got a couple prints after that suggest that maybe not. So I guess it's understandable for the Fed to be waiting.
Yeah, it is. And I think, Powell was one of the people who really believed in the seasonals. I think some of the other FOMC members need to be more convinced than perhaps even Powell. But the core PC number should be something like 0.15 in the next month, and the seasonals go the other way throughout the rest of the year. And OER is a big one. OER, we should see the big next step down in the month of June.
We should explain to our audience that OER is real estate.
Exactly. Real estate CPI, real estate inflation.
Okay, very good. And that's a thing for everybody who's trying to rent an apartment in the city. Retail sales tomorrow. How's the consumer doing? What do you expect to see from retail sales tomorrow?
Yeah, that's going to be a big one because the street is looking for sort of a modest gain. But if you look at some of the alternative data, it looks like it could be running a little bit hotter. Some of the credit card data look a little bit stronger, like you might actually get a bit of a bounce back. If you net out what we've seen for the bulk of this year, it's been a consumer that's spending, but slower than what we saw last year, which is arguably a good thing. I mean, especially good spending was so strong last year, it was kind of unsustainable.
So give me a proportional analysis here. What's your forward view on real GDP, the one everybody follows, but also nominal GDP, real GDP plus the inflation element? What are those two numbers forward?
Yeah, so we're looking for something around a 2% real GDP growth, which is kind of historical average. That's a normal trend-like growth. Solid. And then if you add a 2.2% something inflation like that, then you're looking at a 4.2% nominal GDP growth.
Well, where's the gloom? I mean, all weekend, Sam Rowe out with a spectacular 6 charts from the different street sources showing, I'm sorry, it's a bull market because actually the economy's pretty good.
Yeah.
Stephanie, is that safe to say?
Yeah, the economy is good, and it's been an impressive rebalancing. We were coming from a place where inflation was running at 9%, and it's come down back to something that's very close to what the Fed's looking at. And now we're looking at inflation to several decimal places. We were in a position where who cared?
Is that Bucknell's fault? Where did that come from?
Nice.
I mean, who cared what inflation was to the second decimal when you were seeing 0.6% month-on-month prints? But now that we're talking about something between 0.1 and 0.3, it matters.
No, but you can't. In other times of disinflation, the early 1950s, nobody was looking to 3 decimal points. That's a modern idiocy.
That's fair, and I mean, there's so much Fed communication, and there's just all of that has changed a lot over the number of years. But now we're in an environment where it matters.
Paul was at the beach this weekend studying central limit theorem.
Exactly.
Take it over.
Talk to us about this. The labor market here, because I know the Fed's looking at the labor market, and we're pushing up to 4% unemployment, but still a fully employed economy. How do you think about this U.S. labor market?
A lot of it has been driven by immigration. And by that, I mean, we were coming from a place where the labor market was really tight. And we had a really strong influx of immigration, which is still ongoing. And that helped to rebalance the labor market or add a lot of supply where there wasn't really supply. We don't have that much as strong sort of domestic labor force growth. But now we got it from the outside. And these programs are ongoing until perhaps the next administration. And then it could change a bit.
So on a non-farm payrolls, pick a number. What's the immigration plug there? Give our audience scope and scale. When people toss around the phrase immigration, how much of that's in non-farm payrolls?
Sure. So when you think about the steady state of payrolls growth, forgetting about immigration, we're talking somewhere, there's domestic growth of 85 to 100,000. That's without sort of strong immigration trends. Immigration trends roughly double that.
Double?
Roughly double that. So, for example, the Biden administration humanitarian parole programs, which is bringing in people from Mexico and then Cuba, Haiti, Nicaragua, Venezuela, bringing in 75,000 people per month, and they're able to get a work visa within 30 days. So presumably if they're working.
This is too important. You're telling me we got a run rate non-farm payrolls of 100,000 a month, and you're willing to pop that up to 180 or 200 based on immigration in America?
Yes, that's why this has been
Is
such
that in the
kind of
zeitgeist?
rebalancing.
Look at this. Torsten Slock, our good friend from Apollo, just out with a note going to the same issue. The foreign-born labor force has grown 11% since February 2020, and the native-born labor force is unchanged over the same period. So the growth in the labor force is entirely driven by immigration.
And by the way, that data might not even be fully capturing all of the immigration because they're having trouble, especially in the household survey, which is what captures that, all of that.
Bob, can we slot Stephanie in near Jobs Day and just tell her people she can't be so mathy?
Yes.
Because then it's like emotional. This is great. You know, how do kids get so they love statistics? How do we get back to when we were kids and you had to take statistics at gunpoint? And you did it and nobody complained. You just took it.
Yeah, that's fair. I mean, I think it's kind of fun. You learn a lot from just digging into the data.
That's foundational.
Yeah, it totally is. I mean, especially these days where the data are just so funky in the post-COVID
I sit
period.
at the dining room table and start talking 1 over square root of t, and the kids, they throw vegetables at me. Stephanie Roth, thank you so much. She is with Wolfe Research. Stephen Major has led on this at HSBC, vigilant about a low-rate regime with HSBC Hong Kong. Stephen Major, are we finally to the low-rate regime you've been predicting?
We've had to be very patient, Tom. It seems to be coming through, and I think the catalyst was obviously not predicted by anyone. It seems to be the elections, maybe in France and Mexico. They have one thing in common. They both bring chaos and concerns on the fiscal front, and bonds don't like it in those countries. And that feeds into the safe havens like treasuries and bonds. And so I think that's helping, and it's taking the focus a bit away from every data release in the US and every Fed speaker.
Do you, as a grizzled veteran, do you get any value from monitoring the credit default swap market, or is it just too illiquid where Steve Major stays looking at full faith and credit bond market data?
Yeah, it might give us a clue on sentiment and direction, but no one's going to default here. So the French spreads moved a bit, but the more interesting one, so the French CDS has moved, but the one that's more interesting is the comparison between bunds and OATs, say in the 5-year segment. So I think CDS gives us some sort of warning, but I don't think it's particularly liquid. And I think you get much more value looking at the proper government bonds and their asset swap spreads.
So, Stephen, I'm kind of lazy enough to just say, I think I'm just going to sit around in this U.S. 2-year Treasury and get 4.75%. But you're the global head of fixed income at HSBC. Do you got anything more exciting for me than just the U.S. Treasury?
I don't think you're wrong on the 2 years. You might want to go a bit longer. The way I explain it to people is sort of simple opportunity cost. And to make it really simple, if you roll bills for 1 year, you can get 5.25 to 5.5. But you see, if they're cutting rates, you won't get that in a year's time. So locking in for 2 years at 470-ish seems like a good trade. Elsewhere globally, I think you can find some of the emerging markets are looking quite interesting. India has been resilient in all of this recent volatility, because when volatility goes up, spreads go out. But India is not really a spread market; it's on its own. So there's something to say there, and I think in Europe there's still value to be had in government bonds, but you've got to keep away from the hotspots. So it's more like Spain, for example, that's attractive, and again Germany is the one that wins in this situation. But I know that 4.7 doesn't sound very exciting, and you're looking for some more sex, drugs, and rock and roll. But in the bond market, I'm afraid it's supposed to be boring.
Exactly. How about credit risk? If I want to take a little bit of credit risk, where do you see some opportunity out there? I know a lot of folks are telling me spreads are so tight.
You've got to get defensive, and we're shortening in terms of spread duration. And what that means in plain English is we'll go to the front end. We can take some sort of more defensive trades. Some of those haven't gone very well recently because it tends to push you into banks, and banks don't like some of the stuff going on. So high yield is okay at the front end, but you get your duration from the right place, the Treasury market.
Steve Major, how do we flip from our focus on short duration and move out to the belly of the curve and even out farther? What is the exercise or the process where mere mortals decide to have the confidence to buy longer?
Yeah, I mean, I have to say, hand on heart, it's very difficult to give a strong guarantee about buying 10 years or longer in terms of the term premium. So that's part of the problem, because you know what the scenarios are around the election. A lot of the risks are known. At least if you're buying the 2s to the 5s, you should be okay, because the yield to maturity there is really driven by the policy rate and the expectations for that policy rate in the near term. Now, there's not much that either candidate's going to do to affect where Fed funds is going to be in 1 year's time. They might have an impact in 5 to 10 years' time. And that's why it starts to spill into the term premium. I think there's already a fair bit of term premium there. Right. I mean, everyone on the call, everyone who's listening to this knows there's a lot of debt, right? Everyone knows what the likely policies are going to be of either candidate. So it's not like it was in 2016.
Steve, it's time now, and we got to do this. It's time for our obligatory soccer talk. I'm looking at Italy, and they snuck by. It wasn't Montenegro, it was Albania. Yeah. And England snuck by Serbia. But I'm looking at there's some like real games coming up, like Netherlands, Austria, France, Poland. Like some of these brackets are interesting. Does England have the easiest bracket since time began?
No, there's no easy games. And I think that the first challenge is get out of your group. And in tournament football or tournament sports even, you have to play your way into the tournament. This thing is four weeks or so long. So it's best not to start too well. I would have thought that Germany and Spain would be worried about how well they play. I mean, save your best game to the final. And I think England did a good job of starting in a very average way.
Like Tottenham. Very good. Steve Major, thank you so much. The Tottenham strategy to football. Let's be average and win.
So this is what? This is the Euros?
I can't keep up.
I can't keep up. I mean, but I will pay attention because I do like it when the countries
we have interview notes, okay?
Yes.
Like Anthony Cosenzi, talk about his damn pool in Staten Island.
Yep.
Steve Major, you have to talk about West Ham football or whatever England's doing. We should say thank you. Steve Major, thank you so much with HSBC. We need to dive into this, and we're going to get him on many times here as we dive into the summer. David Rosenberg owns the study of inflation. He was literally iconic at Merrill Lynch in parsing inflation. Frankly, folks, he invented it. He did it before anybody, and it's good to have him on when he's right, which is we've got a new disinflationary tendency. How extensive, David Rosenberg, can our disinflation be?
Well, I think that the disinflation momentum, which has restored itself after some of the earlier distortions, it's going to surprise a lot of the what I call inflation phobes. I think we're going to finish the year very close to 2% on headline inflation. And the way I'm seeing the aggregate supply, aggregate demand curves behaving, I think we're going to get down towards 1.5% by the end of next year.
Wow.
So, David, what drives that inflation down? Because if you talk to the folks on the street, they're saying, boy, my supermarket and the gas station, I'm just not seeing it. What's going to be taking us down that route?
Well, I think the problem is that people tend to conflate prices with inflation, and inflation is not the price level. It's call it the year-over-year percent change in the price level. I mean, look at Paul Volcker, in the Hall of Fame of central bankers for being the greatest inflation dragon slayer of all time. But, nobody calls him the CPI dragon slayer. Prices never went down under Volcker. In fact, the CPI in a 7-year tenure went up 40%. What he's renowned for was taking the inflation rate down from 14% down to 4%. So, yes, prices are high, undeniably. But the rate of change is dissipating. We had a couple of earlier quirks. Let's face it, a lot of it was auto insurance in response to the lagged run up in claims. That seems to have run its course. The rental measures are taking their time subsiding, but we know that that's staring us in the face. My analysis is just strictly top down. It's really looking at where's the output gap today, and then what's your forecast on how the aggregate demand and aggregate supply curves are moving? But
then, David, what is this Fed going to do? You are a great student of the history of our central bank, and there's this absolute delusion I see that the Fed can get out front. Don't they, by definition, have to be dramatically ex post and wait for the Rosenberg disinflation?
Well, I don't think that they have to wait. I think that the Fed is still somewhat shamed for having missed 9% inflation in the summer of 2022 and leaning so hard on transitory, although 18 months in real time doesn't sound transitory, but in the overall annals of economic history, 18 months is still pretty transitory. But they still seem to be fighting for their credibility. When they talk about that they need more confidence, just saying that they need more months or many more months of the disinflation trend that really dominated most of last year. So I think that part of it is just basically the horrible memory of what happened in 2021, 2022, and blowing the call. And that's one of the reasons I think that they're going to be deliberately slow to start cutting interest rates. But I think when they do, they're going to be pretty significant.
Are they deliberately slow, David, or are they already behind the curve in terms of not cutting rates?
Well, look, the yield curves told them they've been behind the curve for at least a year. I think that, what got in the way last year was the boost to aggregate demand from the fiscal stimulus. Not many people thought the deficit was going to expand 25% in a year when the unemployment rate was south of 4%. I think that was part of it, was the fiscal stimulus. And I think nobody at the Fed was expecting that every penny and then some from the excess savings file was going to be used to stimulate, consumer expenditures. But that did happen, all in the rearview mirror. So I think that, that are they behind the curve? I think they're behind the curve. I think that people will be surprised at how soft the demand side of the economy, well, as it was in the first quarter, but going forward. But also, I think that the confidence the Fed needs on the inflation front is going to come. I think they'll be cutting by the September meeting.
David Rosenberg with us, Rosenberg Research, Toronto. We continue. Paul Krugman, the laureate, publishing in the recent hours, and he agrees with Rosenberg. Headline, ex-shelter 2.1%, core inflation, ex-shelter sub 2%, 1.9%. What does the stock market do, David Rosenberg, given a disinflation? I understand there's an ambiguity there. Which way does it tilt?
Well, Tom, when you're asking me about the stock market today, you might as well just ask me about what's NVIDIA going to do. It's NVIDIA, Microsoft, Apple. You could argue that when investors are pricing in for NVIDIA, which is a long-term accelerating growth profile, has nothing to do with the contours of the business cycle. But I mean, come on, we have 3 stocks that account for 20% of the S&P 500. Half the stock market is actually languishing below the 50-day moving average. And look at what the small caps are doing. And you look at the widening divergences in the stock market. It's really quite impressive. But you're just looking at NASDAQ and the S&P 500. I guess that it has nothing to do with anything. That basically maybe NVIDIA will just be Jack and the Beanstalk, right? And is impervious to the business cycle. But that, if you're talking to me about what mega cap tech stocks would do in a disinflation environment and in a lower rate environment, well, considering that they're the longest duration stocks in the stock market and they have command the biggest market share, maybe the major averages, maybe outside the Dow, because they don't have those constituents, continue to go up. But it's not giving you any sort of real economic signal.
Okay, but Paul, what's important here, Rosenberg harkens back to the concentration of the Canadian stock market, which used to be Canadian Pacific, Toronto Dominion Bank, and Molson Golden. Peter Lloyd was my stockbroker years ago, and he said Molson Golden is one of the big 3 of equities in Canada.
Absolutely. I'm right there with him on that. No problem. So, David, how do we think about, the earnings power of some of these, of the S&P 500 here? It seems like the earnings have been pretty solid. I mean, I'm not sure what that's telling us about this economy here.
Well, everybody says it's an earnings-driven market, but what are earnings up over the past year? 6%, right? And the S&P 500 is up more like 30%. So, if we had the stock market up 6%, earnings up 6%, I'd say 100% earnings-driven market. But it's been principally a multiple-driven market, and that's just a sign of what? Animal spirits, momentum, psychology, sentiment. These are important things that go into the stock market. But I would say that earnings have been okay. They certainly don't justify the level of the market price that we have right now. But of course, when you have the major mega growth tech stocks pricing in a future of 5 years of huge double-digit growth, and in fact, with NVIDIA, more like triple-digit, well, you're going to get this market action. But last October, the Ford multiple was even lofty then. It was sitting at 18. Today, it's 21, 3-point multiple expansion. And that's without the benefit of the Fed doing anything. So a lot of this is just basically classic John Maynard Keynes animal spirits and a tremendous level of confidence over the future. But to tell me in the here and now that this is earnings driven, really it's been 1 part earnings and it's been 5-part multiple expansion.
So are those big tech Magnificent Seven, or however many names are in that group today, are they? Should investors be getting out of them, lightening up on them, hedging them?
I would. That's what I would recommend. But we're talking about tremendous emotions that always grip the stock market, which is fear and greed, and everybody always thinking they can get out of the top. I'm a big fan, not just of diversification. Well, that's been thrown out of the waste paper basket. But I've been saying that what is wrong with rebalancing the portfolio? But I'm finding that so many investors now have fallen in love with their stocks. My motto is fall in love with your partner, not your portfolio.
Oh, listen, Dr. David giving us some advice there. Thank you so much. David, I got one final question. Mr. Trudeau at G7 looked as lost as all the rest of them. What's the political calendar in your Canada? When is there an election to determine the path of a beleaguered Canada?
Well, October of next year is the election date for Canada. And right now the polls are showing that the Conservatives are going to win a landslide majority. And every poll is saying the same thing. So chances that we'll have a new prime minister just over a year from now.
Maybe Justin Trudeau could become GM of the Montreal Canadiens. That'll fix him. David Rosenberg, thank you so much with Rosenberg Research. Always good to speak to, but particularly when disinflation clicks in. Massive email. She was in Atlanta. They're like, are you kidding me? Where are the newspapers? Have them do it from the deep south. Your front pages with Lisa Mateo. Lisa, you were missed. Go.
Oh, thank you. All right. So you heard about how weight loss drugs, right? There's a problem. Food companies are worried. It has everyone, up in arms. But clothing retailers are actually saying it's helping sales because more slimmer Americans, they need to buy new clothes, right? They have these new sizes.
Really?
They have to buy new clothes. This was in the Wall Street Journal. You got to check it out. And they don't just want a regular wardrobe. They want, body hugging shapes. They want sexy clothing to show off their new size.
Yeah, like
so
what I wear.
The brands are doing it. They're replacing zippers with adjustable corsets. They're adding more sheer looks to some of the looks that they have. So it's a shift that these retailers
this is
are
a real
looking
story
for.
in a Wall Street Journal.
Yes. They're seeing the shift because they needed the boost. The clothing
Can I
retailers
just say,
needed the boost.
Jon Ferro was way out front on this. I mean, I'm like, what are you talking about? Where are we 2 years from now with Ozempic, with the Lilly product? Where are we in? It's like $900 a year. Am I right?
It's a lot because it depends on if your insurance covers it or not,
right.
because some do, some don't. But it's just expanding in so many different ways. I mean, all these studies showing how it helps with this and helps with that. There's now maybe one for like pets. I mean, it's getting crazy. Ozempic for pets,
I'll tell you what,
maybe.
it works. I haven't seen it firsthand.
Yeah,
it works.
Seen it.
Okay.
All right, it's a thing. I'm not, I was poo-pooing it all, but it is a thing. My experience is there's no appetite.
Right.
You know,
But that's the thing. So you lose all this weight. So you
I don't
need a
get
whole
it.
new wardrobe. You got to spend
How
money.
does your body keep functioning?
It does, but you wind up losing
protein
muscle.
drinks. Yeah, so you got to be.
That's the only problem.
You
got
got to be exercising. You got to be doing the Lisa Mateo crazy in the basement exercise thing. Is it arms or legs today? What are we doing today?
Today's upper body.
Today's upper body.
Thank God for that.
Okay, good time.
Yeah, mine's upper body too. Here, let me pick up this glass of Tang. Next.
Here we go. Apple. This was actually an interesting article from Mark Gurman over in the terminal.
Always.
Taking it slow with the new artificial intelligence offerings that it said it was rolling out. It's going to stretch into 2025. You have the companies. It won't be available for developers to try out until later this summer. When it does launch in the fall, it's going to come as a preview, and some users might even have to join this wait list. But what Mark Gurman is saying is that there are benefits to this kind of staggered approach. He's saying that it prevents like choke points with staffing, but it also gives them more time to train AI models for other languages. So there's different benefits. There's a thought process behind the madness.
All my radars
basically.
up. Paul, what do you think? All my radars up.
Well, I'll tell you what, Apple, as Mark Gurman was reporting, this is kind of what they do. They don't seem to feel the need to rush to be first. They'll be like, we'll be second, third, or fourth, but when we come in, it's going to look awesome. And
Okay,
people
so
are going to say, okay, now I need this smartphone.
This weekend on my phone, Google is giving me AI now. And I dutifully went in to try to figure out how to get rid of it. And you can't. They're forcing me to take some kind of AI in my search function that I really don't want.
Did you try it? You didn't even try it?
It's just too much noise. It's just too, I mean, all my radars up.
Yeah, we'll see. We'll see. But Apple will be
Do people want this? I mean, like Siri, I get the phone. Do you want Siri? I go no, and I move on.
Really?
How many people are like that?
Very few, I think.
But I think it's the fact if you could say, hey, Siri, can you return this shirt that I bought last week? And Siri can pull up the email, find it, send the email automatically to return it so that you can, I mean, it does the work. If it can do that for
Lisa
me.
sold me. Lisa sold me.
I'm sold. It makes my life easier.
Next.
Okay. Wells Fargo. This is interesting. They're losing millions of dollars a month. It had this fancy rent credit card that it came out with about 2 years ago. It launched it with Built Technologies. So the perk is that users can pay for rent without incurring fees from their landlords, while also earning reward points. But the thing is, it kind of backfired because their executives thought that people would kind of get into debt and they can make some revenue if people just charge their rent on it. But people didn't do that. And so they didn't make any money on it. They're losing actually $10 million every month, according to the Journal.
I read every word of the article.
Oof.
It's all accurate. I have lived it.
Really?
And it is a disaster. It's been a disaster for months. There's actually, as I mentioned late in the article, some security issues where people got into my accounts, and there's many, many other people, not just me, but it's a perfect example of a conservative belt and suspenders company going, we need to be cool and digital, let's just do it.
Right. Okay.
And it rarely works out. I thought it was a really important
Pay your
article.
credit card debt every single month. Do not let it ride.
That's what I
what
did. Right.
That's what the advice was for the offspring, and I think they're following it.
Yeah.
That's what I
Until they're not.
Yeah.
Until they're not.
Do you have one more?
I do. Okay, more parents, speaking of debt, they're
No,
taking
this is
on
silly.
debt to pay for their Disney vacation. Prices are soaring. This is a survey from LendingTree. 45% have gone into debt for the trip. That's up from 30% in 2022. How much debt? About $2,000, they're saying, on average. So they're charging up just to give their family that experience that they say they did. They said they don't regret it. No regrets. About 60% said they don't regret it.
It'll be interesting to see. Travel's fascinating. I guess every seat's taken, but prices are lower, into the summer. Well, see, Lisa Mateo, thank you so much. The newspapers. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.